Hey guys, welcome to DevTech Finance and here's another video on EBIT EPS analysis. So let's start with the agenda for our video. First, we would talk about the EBIT EPS analysis where we would try to understand how this analysis is done and what does EBIT means, what does EPS means and how it helps in forming the most optimal capital structure for the business. Then we would understand about the financing part of income statement. We would try to understand the concept of capital structure and various sources through which capital financing could be raised. And at last, we would try to see how EPS differs under various capital plans with the help of some numerical examples. Introduction. EBIT EPS analysis is an important tool used to optimize the capital structure for highest earnings for shareholders. So, here in this analysis, we are trying to analyze how the EPS is what it's earning per shareholders. So, how it would differ at a given level of profit before interest and tax. This is EBIT, which we also refer to as PBIT, which is earning before interest or tax or profit before interest and tax. So if this much profit is earned by the business, what would be the impact on the earning for shareholders if the capital structure is changing? And what could be the capital structure like the business was in need for expansion. Okay, so for that it needed an extra capital amount for say 50 lakhs rupees. Now it could either borrow that amount from bank in form of debt or loan, or it could issue through equity financing. It could issue shares and raise those funds, or it could go for both the options in certain ratio. So how this different capital structure formations could put an impact on EPS. And depending on that, we would choose the most optimal capital structure from where the funds should be raised. And why this EPS is so important? Because it's ultimate aim of any business to maximize shareholders' wealth, because that's the last profit left for the business. And this is why this tool comes into existence, and it's so important to understand which would be the most optimal capital structure for the business. It helps in understanding the sensitivity of EPS at given level of earning before interest and tax under different sources of financing. So in my further slides, I would show you how under different plans with different capital structure, EPS differs. We get different level of EPS. So this is how it shows the sensitivity of EPS because of the capital structure. It helps in analyzing how capital structure decision is important to raise the value of firm. And we would see how EPS is impacted because certain capital structure, and this is how capital structure plays an important role in raising the value of firm and creating more valuable market scenario for the firm, for the business. An optimal financing structure minimizes the cost of capital and maximizes the earnings. So where the cost would be minimum and the earning would be maximum, that's the most optimal financing structure. So we would look forward to all these things. Let's start with this income statement because it's very important if you want to understand what is EBIT, what is earning per share. So if you are not too much aware about the income statement, which is also referred as profit and loss statement, you can refer to my video, which I had specially made on this topic to get a better understanding. For now, let's have a look. So there, starting with sales, when we deduct the variable cost from sales, we arrive at contribution. And when we deduct fixed cost from contribution, we arrive at earning before interest and tax. So, in EBIT, we are talking about earning before interest and tax. When we deduct the interest on any kind of debt financing taken, we arrive at profit before tax, and deducting tax from this profit before tax, we arrive at profit after tax, and finally we less the preference dividend to arrive at equity earnings. So this equity earnings is also very important because this is the basis for equity shareholders from which we would calculate the earnings per share. So earnings per share would be equity earnings divided by number of shares. So you can see how stepwise all these things are being derived. So when going from first to last, you are going from sales to equity earnings by deducting certain things in between. So, first for this video, we would not consider this sales to fixed cost part because this comes under the operating activities of the business. But in this video, when talking about EBIT EPS analysis, we would have a look at the financing part of the business. So how the capital structure is formed, how the financing is raised. So we need only EBIT till the equity earnings, the data this much. So try to understand. After deducting interest from EBIT, we arrive at PBT. After deducting tax, we arrive at PAT, which is also known as net income or net profit. And after deducting preference dividend, we arrive at equity earnings. And at last, EPS, which is equity earnings divided by number of shares. So let's have a look. What could be the capital structure? Here we are talking about capital structure, where to raise the finance from. Finance could be business always needs finance, either in its formation stage or it's in running stage or any stage. There is always a need of financing too. So where to raise that huge amount from? Whether to go for debt financing, whether to go for equity financing, whether to raise it from preference shares issue, all these things. So what could be the capital structure? Either it could be equity share or debt, or it could be preference share, or a combination of any of these three. So this is how a capital structure can be formed on the basis of these three. Let's have a look at earning per share. So when we are talking about earning per share, we are considering different capital structure scenario. So let's have a look. In plan 1, when we are considering that we would be raising all the capital financing needed only by issuing the equity shares. So what would be the formula for EPS? Then the formula for EPS would be EBIT into 1 minus tax rate divided by number of outstanding shares. Coming to plan 2, when we decided that we need this much of amount for our business, we would go for both the equity shares as well as debt in proportions. So what would be the formula for EPS then? So this formula we would use, which is EBIT minus interest into 1 minus tax rate divided by number of outstanding shares. Coming to the third plan, which could be the combination of all the three equity, debt as well as preference shares. So for example, the business is in need of raising 10 lakhs rupees. Now it has decided that it would be raising these 10 lakhs by dividing it in a ratio, in a proportion to all the three sources of financing, to equity, debt or preference shares. So in that condition, how we would calculate the EPS, that is earning per share? It would be EBIT minus interest into 1 minus tax rate minus preference dividend divided by number of outstanding shares. Plan 4, if the business chose to raise financing from equity shares as well as preference share both, then the EPS would be calculated as EBIT 1 minus tax rate and deducting the preference dividend which need to be paid, dividing the whole by number of outstanding shares. So you can just analyze this structure of formula where denominator is always number of outstanding shares, because we are considering that the business is already having shareholders within it which are holding certain shares in the business. And then there is tax which is needed to be paid, a certain level of EBIT which is considered in the business to be achieved, and then according to the capital structure, dividends are varying, the interest rate is varying, etc. So let's have a look further and try to understand this in a better way along with a problem. So by solving this problem, we'll get an idea how does this EBIT EPS analysis works. So have a look at this problem. ABC Limited has existing equity share capital of rupees 3 lakh. Face value of each share is rupees 100. It has decided to expand its business, for which there is additional capital requirement of rupees 1 lakh. So you understand there is an existing equity share capital in the business of rupees 3 lakh, and now the business has decided that it wants to expand, for which there is a capital requirement of 1 lakh. Now, what could be the 4 alternative sources has been provided to raise that capital? So, plan 1 is to raise full 1 lakh rupees through equity financing. Plan 2 is to raise 50,000 through equity and 50,000 through debt financing at the interest rate of 10% per annum. Plan 3 is to raise 1 lakh full through debt financing where the interest rate is 10% per annum, and plan 4 is to raise 50,000 through equity and 50,000 through 5% preference shares. So, these all information is being provided, and the expected level of EBIT by business is 75,000. So this is the level of profit which is expected by the business. The tax rate prevailing is 30%. Now the question is, which plan do you think it should go for, considering the one which would provide maximum EPS? So 4 plans, as you can see, is given. Now the money required to be raised is only 1 lakh, but that 1 lakh could be distributed in various ways in various sources of financing. So which source or which plan would provide the maximum earning per share? We would go with that plan. So we have to figure out that only. So let's start and calculate under various plans how the EPS would be. So plan 1 was to raise full rupees 1 lakh from issue of 1000 equity shares at face value of 100. So just have a look. We were having existing share capital of 3 lakh. Face value was 100. So what would be the number of shares? It would be existing share capital divided by the face value, and thus we got 3000 shares which are already there in the business, which are already issued. And now the expected level of earning before interest and tax by the business is 75,000. This is what is expected EBIT. And the prevailing tax rate is 30%. Now we have to calculate the EPS for this plan. So we know that the formula for when it was only equity financing, the formula was EBIT 1 minus tax rate divided by number of outstanding shares. So just put the values in the formula and you will get the EPS. So here EBIT we have 75,000, tax rate is 30%, which we could write as 0.30, and we would divide that by number of outstanding shares. So in our business, we were already having 3000 shares, and because we further raised 1 lakh rupees by issuing 1000 shares of face value 100 each, so we are having an extra 1000 shares which we have issued. So this 1000 shares is new shares being issued. So we would add that in the existing shares, and thus we would get the value of 13.12. This is the EPS value which we got under plan 1. Let's move forward and look at other plans. So plan 2, this was to raise 50,000 through equity at face value of 100 and 50,000 through debt at 10% interest rate. So all those information remains the same. Existing share capital 3 lakh, face value 100, number of shares 3000, expected EBIT is 75,000 and tax rate is 30%. Now new equity shares. Because we decided that 50,000 would be raised through equity, what would be the number of shares? It would be 50,000 divided by face value, that is 100, and we are having 500 new shares to be issued. And we raised 50,000 through debt financing at the interest rate of 10%. So what would be the interest on debt? It would be 10% of 50,000, which is 5,000 per annum. Now let's put these values in the formula. So formula when equity and debt both were there, it was EPS equals EBIT minus interest into 1 minus tax rate divided by number of outstanding shares. Okay, so just put the values in the formula and you would get the answer. So EPS would be equal to 75,000 minus interest, we calculated 5,000, 1 minus 0.30 and divided by 3,000, which was existing number of shares, plus 500, which is new number of shares. So solving this whole calculation, we got the EPS of 14 rupees. So this was under plan 2, our EPS value. Let's have a look at the plan 3. So plan 3 is to raise full 1 lakh rupees through debt financing at interest rate 10% per annum. So all the informations remaining same. We know that interest on debt is 10% of 1 lakh rupees because we are raising the whole 1 lakh through debt financing only. So it would be 10,000 interest. Now just using the same formula, EPS here would be EBIT minus interest into 1 minus tax rate divided by number of outstanding shares. So put down the values and we would get the value for EPS. It would be 75,000 minus interest 10,000, 1 minus 0.30, which is tax rate, and number of outstanding shares remains the same, that is 3,000, because no new equity shares have been issued. So it is the same one, the existing shares, that is 3,000. And thus we got the EPS value of 15.16. Now let's have a look at plan 4. It is to raise 50,000 through equity shares at face value of 100 and 50,000 through 5% preference shares. Okay, so let's have a look. All the informations above will remain same because this is what is given in the question, and we decided that we have the business was required to raise 1 lakh rupees, so 50,000 would be raised through equity and 50,000 would be raised through preference shares issued. So 50,000 at 100 face value, number of equity shares would be 500. And what would be the dividend on preference shares? So it is given 5%. So it would be 5% of 50,000, that is 2,500. Now just put the values in the formula. The formula was EPS equals EBIT into 1 minus tax rate minus preference dividend. Okay, here we have not taken interest into consideration. Why is that? Because there is no debt financing. Interest is deducted only when we would raise money through debt. Okay, because there is no debt, we would just deduct the tax rate and the preference dividend which would be paid and divide the whole by number of outstanding shares. So putting all the values, we got the EPS of 14.28. So this is how we see that the EPS is fluctuating. The EPS is changing with different plans, with different capital structure. So what we analyzed is that in plan 1, EPS we got is 13.12, which was the equity financing plan. In plan 2, we got the EPS of rupees 14, which was the equity as well as debt financing. And in plan 3, we got the EPS of 15.16, which was totally debt financing. And in plan 4, we got the EPS of 14.28, which was equity as well as preference shares capital financing. So here you can observe the highest level of EPS is under plan 3, which is 15.16. So this is how we can choose the best plan, because the EPS earning per share is highest in plan number 3. So the business should go for debt financing. However, the business could not always rely on this tool because there is some sort of risk also associated along with debt financing. When the business is raising whole money through debt, there is kind of leverage occurring in the business. So even when the EPS is rising, there is sort of risk in the business. So that is not taken under consideration when we are talking about EBIT EPS analysis tool, which is one of the demerit of this tool. Otherwise, it gives a clear picture where would be the highest EPS. If you just want to consider the EPS and the highest value, therein you can go for this tool to make an analysis of the optimal capital structure. So this was all about this video. I hope you understand EBIT EPS analysis and you liked this video. Thank you for watching. Do like and share my videos. And if you like, don't forget to subscribe to my channel, DevTech Finance. Thank you all.